Financial statements are comprehensive reports that provide an overview of a company's financial performance and position. They are essential tools for investors, creditors, and management to assess the financial health of a business. The main types of financial statements include the income statement, balance sheet, statement of cash flows, and statement of changes in equity. We can also extend that with other reports, like the statement of comprehensive income. So, let's have a quick look at the various reports. Let's start with the income statement or the profit and loss statement. The income statement shows a company's revenues, expenses, and net income, or loss, over a specific period, usually quarterly or annually. Revenues are the income generated from the sale of goods or services, while expenses are the costs incurred in the process of earning revenue. The bottom line of the income statement, which is the net income, represents the company's profit after all expenses have been deducted from the revenue. Take a moment for that to sink in. Read it again so that you have a better understanding of the concepts. So, basically, the income statement focuses on the revenue, expenses, gains, and losses of a company during a particular period. An income statement provides valuable insights into a company's operations, the efficiency of its management, underperforming sectors, and its performance relative to industry peers. Next, we have the balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time, typically at the end of a fiscal quarter or year. It consists of three main sections. It has the assets, the liabilities, and the equity. Let's start with the assets. These are what the company owns or controls, such as cash, inventory, property, and equipment. Again, it's what the company owns. Then we have the liabilities. These are what the company owes, such as loans, accounts payable, and accrued expenses. Remember, assets are what the company owns and liabilities are what the company owes. Equity, on the other hand, represents the shareholders' ownership interest in the company. The formula for calculating equity is the company's assets minus the company's liabilities. This is an important formula to understand because we will be referring to it during the course. So, in a nutshell, a balance sheet, also known as statement of financial position or statement of financial condition, is a summary of the financial balances of an individual or organization, whether it be a sole proprietorship, a business partnership, a corporation, or a private limited company. Assets, liabilities, and ownership equity are listed as of a specific date, such as the end of its financial year. Moving on, we come to the statement of cash flows. A very important report that causes a lot of confusion to students. The statement of cash flows shows how cash flows in and out of a company over a specific period. Again, how cash flows in and out of a company, typically quarterly or annually. The report categorizes cash flows into three main sections, the first being operating activities, then investing activities, and lastly, financing activities. Operating activities include cash flows from the company's core business operations. The key words here being core business operations, such as sales and expenses. The second section being investing activities. These include cash flows related to the purchase or sale of long-term assets. Again, long-term assets, such as property, plant, and equipment. Write that down, or make a mental note of it. It's important to remember that. We move on to have financing activities. These include cash flows related to the company's capital structure, such as issuing or repurchasing stock and borrowing or repaying debt. Again, the capital structure of a company. You must understand the differences between the different sections and what they pertain to. Understanding that will make the compilation of the cash flow statement very, very easy. So, a cash flow statement tracks the inflow and outflow of cash, providing insights into a company's financial health and operational efficiency. We now come to the statement of changes in equity. This report can be very simple to compile, or can be very complex. The statement of changes in equity shows the changes in shareholders' equity over a specific period. Remember, it shows the changes in shareholders' equity over a period of time. The report includes details of transactions that affect equity, such as dividends paid, shares issued or repurchased, and any changes in accounting policies. A brief summary will be net profit or loss, dividend payments, and equity withdrawals. Module 1 of this course is the income statement. So, immediately, after we have been handed the adjusted trial balance, we need to extract the income statement and properly categorize the revenues and expenses. If these accounts are properly categorized, the reports that follow will be easy peasy to compile. As excited as what we are to get started, I would want you to study the theory aspect of the income statement first, and the laws that govern them. It's crucial that you study this section properly before attempting the examples that follow. So, understand that the preparation of a company's income statement is governed by several basic accounting principles and standards. Here are the key ones. Firstly, we have the accrual basis accounting. What does that mean? Well, most companies prepare their income statements using the accrual basis of accounting, which means revenue is recognized when it is earned, and expenses are recognized when they are incurred, regardless of when cash is received or paid. Take note of that. The accrual basis of accounting. Then we have revenue recognition. Revenue should be recognized when it is earned and realizable, typically when goods are delivered or services are rendered, and the amount can be reasonably estimated. So, revenue recognition is an aspect of accrual accounting that stipulates when, and how, businesses recognize or record their revenue. The principle requires that businesses recognize revenue when it's earned. The accrual accounting concept, rather than when payment is received. The cash accounting concept. Next, we have the matching principle. This means that expenses should be recognized in the same period as the revenues they help to generate. Take note of that, the same period that the revenues are generated. This principle ensures that the income statement accurately reflects the expenses incurred to generate the revenue reported. So, the matching principle directs a company to report an expense on its income statement in the period in which the related revenues are earned. Next, we have the conservatism principle. This is a rather interesting principle. Under this principle, expenses and losses are recognized as soon as they are probable, while revenues and gains are only recognized when they are realized. Let's stress a little more on that. Gains should be recorded only if their occurrence is certain, but all potential losses, even those with a remote chance of incurrence, are to be recognized. Understand that principle. When expenses are probable. The full disclosure principle means that all material information, relevant to understanding the company's financial condition and operating performance, should be disclosed in the financial statements or accompanying notes. Take a moment to ponder on that. We then move on to the hierarchy of GAAP, or the generally accepted accounting principles. These principles provide the guidelines for financial reporting. If there is a conflict between the different accounting principles, the more specific principle should prevail over the more general one. Which one to go with and when? Please stop the lesson for a moment and review the concepts discussed. Have a notepad at hand and write down important points to help you understand. The next regulation is an interesting one. The non-GAAP measures regulation. While companies may present non-GAAP principles, the financial measures must be accompanied by the most directly comparable GAAP measure, and there must be a reconciliation between the two. Some common non-GAAP measures are EBIT, which is earnings before interest and taxes; EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and adjusted gross margin or adjusted contribution. The examples are a bit technical in nature, but, as an accountant working for a large corporation, you are bound to come across these concepts. Lastly, we have segment reporting. Companies must disclose financial information about operating segments in the income statement, if they meet certain criteria. This allows users to better understand the company's performance in the different areas of its business. The key benefits of segment reporting include improved transparency into individual divisions, product categories, or geographical units. More informed capital allocation based on segment operating metrics. Remember that adherence to these principles ensures that the income statement fairly represents the financial performance of a company for a given period. Read this section again, become a pro when compiling the income statement, and dazzle your employers with your knowledge. Again, please stop the lesson for a moment and review the concepts discussed. Have a notepad at hand and write down important points to help you understand. So, let's get to it. As we said earlier, the income statement is a financial report that summarizes a business's revenues and expenses over a period of time. If you take a business's revenue and subtract its expenses, you're left with a profit or a loss. That's why it's sometimes called the profit and loss statement or the P&L, but we will start with the basic income statement. Look at the simple structure that follows. Revenue on top, expenses below that, the one subtracted from the other gives us our profit. But this example does not give potential investors any information at all. What did it cost to generate the revenue? How much did we pay our employees? How much was the admin expenses, and so on and so forth. A detailed income statement puts it all into perspective. All income and expenses are properly categorized. Now, prospective investors can see exactly how much revenue is generated, the cost of generating that revenue, the expenses that was incurred, such as salaries, and other admin costs, and how much was spent on non-operating costs. Looks good. Let's break it down for a better understanding. First, we have operating revenue, which is the income earned from doing business. Sounds easy enough. Below that we have the operating cost, or cost of sales. Remember, we said that cost of sales, or the cost of goods sold, is the direct costs incurred in producing goods or services sold by the company. We subtract the operating cost or cost of sales from the operating revenue, and that leaves us with a gross profit or a loss. Read that line again. Gross profit or loss, not net profit or loss. We still have other items that must be considered before we arrive at the net profit or loss. Moving on, we have the indirect operating costs or overheads. These will include, but not limited to, accounting or audit fees, advertising, salaries, and wages, etc. To reach an operating profit or loss. Still not net profit or loss. Lastly, we have the indirect non-operating costs, which are things like interest expenses, and tax, which brings us down to the bottom line, the business's net profit or loss. This section must be read again for full understanding. In the next section we give you an idea as to how to categorize income and expenses. This section is the most important, so read it, study, and understand the context thereof. I will clearly summarize what goes into the various categories of the income statement. I will break down the expenses, or revenue items that falls under the direct operating cost, the indirect operating cost and the non-operating indirect cost categories. So, let's start with the direct revenue and direct costs. These are items that are directly associated with the day-to-day activities of running a business and generating revenue. These costs are essential for producing goods and services. Here are some common examples. Firstly, we have revenue. It's the total amount of money brought in by a company's operations, measured over a set amount of time. A business's revenue is its gross income before subtracting any expenses. Profits and total earnings define revenue. It is the financial gain through sales and/or services rendered. A point to remember is, while revenue is the total earned from sales or other sources, income is the profit earned after accounting for all expenses. Understanding the difference between revenue versus income is crucial for making informed financial decisions, such as budgeting, investing, and pricing strategies. Next, we have cost of goods sold. This includes the direct costs of producing the goods or services sold by the company, such as raw materials, labor, that is, directly involved in production, and manufacturing overheads. The cost of goods sold is the sum of all direct costs associated with making a product. So, a brief explanation is, it appears on an income statement and typically includes money mainly spent on raw materials and labor. Next, we have direct labor as explained earlier. These are wages and benefits paid to employees directly involved in the production process, such as assembly line workers or machine operators. Direct labor refers to the salaries and wages paid to workers that can be directly attributed to specific products or services. It includes the cost of regular working hours, overtime hours worked, payroll taxes, unemployment tax, medical aid, employment insurance, etc. Next, we have direct materials. This is the cost of materials and components used in the production process. Direct materials are those materials and supplies that are consumed during the manufacture of a product, and which are directly identified with that product. Items designated as direct materials are usually listed in the bill of materials file for a product. Let's discuss manufacturing overheads. This one can be a bit tricky. So, these are other costs associated with manufacturing that are not directly attributable to specific units of production, such as utilities for the production facility, depreciation on manufacturing equipment, and factory rent. It is the sum of all the indirect costs which are incurred while manufacturing a product. It is added to the cost of the final product along with the direct material and direct labor costs. This is also known as product costs. We now have distribution costs. These are expenses related to getting the finished product to the customer, including shipping, packaging, and warehousing costs. Distribution costs are costs to sell or market products in different territories. They are the costs for activities, after goods are produced, and until they are received by the customers. In a nutshell, distribution costs measures a company's expenses related to the order fulfillment of products and services to the customer. Example costs include transportation cost, warehousing cost, handling costs, import-export duties, order management cost, depreciation or amortization, and other costs. Lastly, we have sales commissions. These are payments made to sales staff, or sales representatives, based on the volume or value of sales. A sales commission can be an extra payment for a salesperson's performance. This payment can be based on either the number or the amount of their sales. The commission may be a flat rate, or it can be computed as a percent of their sales, meaning for every sale, they earn a certain percentage as commission. In closing, I need to say that expenses and revenues are necessary for the day-to-day functioning of the business and are subtracted from the company's revenue to calculate its operating income or operating profit. So, there we have it. These are some of the items that are easily identifiable and can be categorized as direct revenue or cost of goods sold. As practice activity number 1, I urge you to look up a company's adjusted trial balance and see if you can correctly categorize its direct revenue and cost of sales. Stop the lesson and study this section. Make notes wherever you can, so that you can remember important points discussed. Let's look at some indirect operating cost definitions. These are also known as operating expenses. These are expenses that are necessary to keep the business running, but are not directly tied to the production of goods or services. These costs typically appear on the income statement and can include administrative expenses, selling and marketing expenses, research and development expenses, depreciation and amortization, insurance and taxes, rent and leasing expenses, and the list can go on and on. So, let's start with administrative expenses. These include salaries and wages for administrative staff, office supplies, utilities, and other costs associated with managing the business. So, administrative expenses are costs related to the general administration of the business and do not relate to any function like production and sales. Next, we have selling and marketing expenses. These are costs that relates to promoting and selling the company's products or services, such as advertising, sales commissions, marketing materials, and travel expenses for sales representatives. So, marketing and advertising expenses are typically considered part of selling expenses. These expenses encompass activities like advertising campaigns, online marketing efforts, print media, television or radio commercials, and other promotional strategies aimed at reaching potential customers and generating sales. We now come to research and development or R&D expenses. These are costs associated with developing new products, improving existing ones, or conducting research activities. R&D expenses include the original development and design of the product, as well as any enhancements you and your team choose to make over time. R&D expenses are included within the overall operating expenses and typically reflected as an individual line item on an income statement. Let's look at depreciation and amortization. The allocation of the cost of tangible assets, depreciation, and intangible assets, amortization, over their useful lives. So, the term depreciate means to diminish in value over time, while the term amortize means to gradually write off a cost over a period. Depreciation is recorded to reflect that an asset is no longer worth the previous carrying cost, reflected on the financial statements. We now have insurance and taxes. These are insurance premiums and various taxes, such as property taxes, business taxes, and other regulatory fees. Looking at rent and leasing expenses. These are costs associated with renting or leasing office space, equipment, vehicles, etc. Moving on to utilities and maintenance. These are expenses for electricity, water, heating, and maintenance of facilities and equipment. We now come to professional fees. Payments that are made to consultants, lawyers, accountants, and other professional service providers. So, these are fees that refer to the charges or compensation that professionals charge for their expertise and services rendered to clients or customers. Coming to training and development. These are costs associated with employee training programs and development initiatives. Lastly, we have travel and entertainment. These are expenses that are related to business travel, meals, and entertainment for clients or employees. These are expenses you incur when you travel or entertain for business purposes. Remember that all of these costs are essential for the operation of the business, but are not directly attributable to the production of goods or services. They are necessary to support and facilitate the overall business activities. So, there we have it. These are some of the items that are easily identifiable and can be categorized as indirect operating costs. As practice activity number 2, I urge you to look up a company's adjusted trial balance and see if you can correctly categorize its indirect cost. Stop the lesson and study this section. Make notes wherever you can, so that you can remember important points discussed. Our last section will be indirect non-operating costs. These are expenses that are not directly related to the core operations of the business, and do not arise from day-to-day business activities. These expenses typically appear after the operating income section of the income statement. This section can be quite cumbersome, but it's important to learn the definitions and the expenses that fall in this category. Some examples may include interest expenses, losses on investments, foreign exchange losses, and so on and so forth. Let's discuss a few of them, starting with interest expenses. These are interest paid on loans, bonds, or other forms of debt financing. A point to remember is, in finance and economics, interest is payment from a borrower or a deposit-taking financial institution to a lender or depositor of an amount above repayment of the principal sum, that is, the amount borrowed, at a particular rate. It is distinct from a fee which the borrower may pay to the lender or some third party. Next, we have losses on investments. These are losses incurred from the sale or write-down of investments that are not part of the core business operations. Remember that. Not part of the core business operations. A loss, in contrast, means the price has dropped since the investment was made. Put simply, a gain is an increase in the value of an asset, while a loss refers to the loss of value. Both gains and losses can be divided into realized and unrealized. Let's look at foreign exchange losses. These are losses incurred due to fluctuations in foreign currency exchange rates. Expanding a little more on that, I will say, a foreign exchange gain or loss occurs when a company buys or sells goods and services in a foreign currency, and that currency fluctuates relative to their home currency. It can create differences in value in the monetary assets and liabilities, which must be recognized periodically, until they are ultimately settled. Next, we have impairment charges. These are write-downs of the value of long-term assets, such as goodwill, intangible assets, or property, plant, and equipment, when their carrying value exceeds their recoverable amount. We can also say that an impairment charge is a process used by businesses to write off worthless goodwill, or report a reduction in the value of goodwill. The impairment may be caused by a change in the company's legal or economic circumstances, or by a casualty loss from an unforeseeable disaster. For example, a construction company may face extensive damage to its outdoor machinery and equipment due to a natural disaster. Coming to restructuring charges. These are costs associated with major restructuring activities, such as layoffs, plant closures, or other significant changes to the business structure. So, a restructuring charge is a one-time expense that a company pays when reorganizing its operations. Next we have legal settlements. These are payments made to settle legal disputes or lawsuits. In law, a settlement is a resolution between disputing parties about a legal case, reached either before or after court action begins. A collective settlement is a settlement of multiple similar legal cases. The term also has other meanings in the context of law. Know that there is a difference between legal fees and legal settlements. Next, we have asset disposal losses. These are losses incurred from the sale or disposal of assets at a price lower than their book value. Remember this one, it will come up when we do the statement of cash flow. So, a loss results from the disposal of a fixed asset if the cash or trade-in allowance received is less than the book value of the asset. The company also experiences a loss if a fixed asset that still has a book value is discarded, and nothing is received in return. Lastly, we have unusual or infrequent expenses. These are expenses that are not expected to occur regularly or are not part of the normal course of business operations. Remember this. Operating expenses include administration and advertising, while interest and taxes are some of the non-operating expenses. Unusual expenses are extraordinary or one-time in nature. The company does not incur these expenses every period, but they may have a significant effect on profits and cash flow. These non-operating costs are typically reported separately on the income statement to provide a clear picture of the company's financial performance from its core operations as well as from other activities. They are often excluded when assessing the operating performance of the business because they can distort comparisons and analysis of the company's operational efficiency. As practice activity number 3, I urge you to look up a company's adjusted trial balance and see if you can correctly categorize its indirect non-operating cost. Stop the lesson and study. Let's jump to the juicy bits. Remember we said that the adjusted trial balance is our starting point. Well, here it is. Have a look at Omatla's adjusted trial balance. The top section is the income statement, and the bottom section is the balance sheet. So why don't we just use the trial balance and go no further? After all, it contains the income statement and balance sheet, right? Wrong. Even though the trial balance has the income statement, a closer look reveals that our income and expenses is not properly categorized. Doing a cash flow statement from a trial balance will be very difficult indeed. We have split the trial balance for you and shown you some expenses, but when lifting these figures to the income statement, we will need the assistance of the section that we just covered, the categories, or how to categorize the income and expenditure. So, by using our knowledge on how to categorize the income and expenditure, we simply lift these numbers out of the adjusted trial balance and put them in the corresponding sections of the income statement. Looking at the opposite page trial balance, we can see a complete list of Omatla's accounts and closing balances. Debit balances go in the left column, which is expenses, and credit balances go in the right column, which is revenue. But how does this help us make an income statement? We have Omatla's balance sheet accounts, which we can ignore for now. The section below the dotted line. We're interested in information on Omatla's revenue and expenses, which are their income statement accounts. So, the basic income statement is Omatla's revenue minus its expenses. In this case they earned 60,000 rands in revenue and had 50,350 rands in expenses. Let's stop the lesson right there. I want you find to the figures that I just mentioned on the top section of the adjusted trial balance. Look at each line item, add where necessary, subtract where necessary, but find the figures. It's important that you understand this section. Start the lesson when you are ready. Onwards and forwards, troopers. Let's continue. There is 9,650 rands in profit, which become retained earnings, but how do we make the detailed income statement? See the illustration and find these figures. We start off by using an exact replica of the opposite page, or the top section of the trial balance, which usually is the income statement. We simply categorize each line entry. Take note with depreciation and amortization, if the long-term assets that they relate to aren't used in operations, then these would be indirect non-operating costs. If you paid careful attention to the section of the categories, You would remember that I mentioned that depreciation and amortization can also fall in the category of indirect non-operating expenses, if the asset in question is not used in operations of the business. We find out that we have revenue of 60,000 rands and 17,500 rands in cost of sales, which is a direct operating cost. The revenue, minus the cost of sales, gives us a gross profit of 42,500 rands. That's a good start. Having properly categorized our indirect operating cost, hopefully you followed the instructions on the category section correctly. We deduct indirect operating costs from our gross profit to reach an operating profit of 10,450 rands. Again, once we have properly categorized our indirect non-operating costs, which is interest and tax, we subtract that amount from the operating profit or loss. That leaves Omatla with a net profit of 9,650 rands. And that, my good people, is really all that there is to it. Easy peasy. Now, before attempting the test that follow, I would highly recommend you study the entire income statement section properly, because a lot of theory questions is asked before an income statement needs to be compiled. Good luck with the test. If you correctly followed my instruction throughout Module 1, this is the end result of the extraction, from the adjusted trial balance, to the income statement, properly categorized. If any section or category was unclear, go back to that section and see if you missed or misunderstood something. Check with your lecturer to clear any misunderstandings that you may have. Again, good luck with the test that follows. My hope is that you understood the concepts taught and would take what you have learnt about the income statement to the real working world. Make me proud. See you in Module 2, Understanding the Balance Sheet.